All right, everybody, welcome. We're about to be, if you can hear the sound of my voice, raise your hand. Yes, anybody? I don't see anybody raising their hand. Let me just. Yeah, the microphone seems to be working, but nobody's raising their hand. All right. Somebody online that can hear us, raise your hand. I know Terry knows how to do that. There we go. Thank you. Now they're chatting. We can do all that later. I would say any questions will be at the end. And you're
Awesome. Great. Thank you guys for taking time to come out today and learn some more stuff about what's going on in the market, and the warranty information is pretty good too. I don't really know much about home warranties. I'm not really part of anything I do, but I always love to hear about it because I have Samsung products and they're terrible. Don't buy them. Yeah, 2015, I did a new kitchen, and the fridge, it's 2022 right now. It's made ice, I think, 4 times. Warranty came out 5 times, replaced the ice maker 3 times. It's never worked, so I buy ice. Whatever, it is no big deal. It's California. I mostly drink wine. So, okay, so we're going to get started, talk about kind of what's going on in the market right now. I know that you guys are probably feeling the pain of interest rates skyrocketing this year. We knew it was going to happen. We kind of could tell last year that that's where it was going to go. And it did, but it just went a lot faster and a lot higher than we anticipated. So it's given a lot of people in the market, realtors and buyers, sellers too, you know, kind of, they're scared, kind of shaking in their boots, you know, like it feels like Armageddon out there. And I'm just here to tell you it's not, okay? It's not as bad as it sounds. There's still some really great things going on in the market. What I'm hoping today to do for you guys is give you some talking points to help explain to your clients when you're talking to someone about buying or listing their house, to help ease their concerns and position you as the expert, okay? Because there's narrative out there from the media and everyone's got their own opinion. I mean, I don't know, maybe there's an economist in here, but I'm not one. So I'm reading reports and kind of gathering my own opinions and looking at trends and things like that. So basically, when you're talking to your people, you just want to hit the high points. We don't have to get into, you know, the deep, dark details of why rates have done what they've done, but I've got some information I think will help you in your presentations and in your meetings and just in general. So we're going to talk about rising rates. I've got some scripting to help you with objections to that. When your people say rates are too high, I'm waiting for them to come back down. That's probably not going to happen. So we'll just get started and we'll have some Q&A at the end. But if I'm talking about something, you want to raise your hand, go right ahead. You know, we'll address it at that time. Okay. Market update. So this is as of the first quarter, basically, of this year. We've got mortgage applications. Oh, it's not working?
It's there.
Okay.
It was on both of them.
For you guys online, we got one of our monitors went out. If you'll just give us a second.
Well.
Okay.
Do you know how to close that?
I was just going to minimize the chat bar in there. So.
Yeah.
If we can't get that going and you guys want to scooch over here to be able to see the screen, you can. It's just a bunch of words. I don't have any really pretty graphics. I've got a few charts there, pretty cool, but it'll be up to you guys. Do you want me to keep going or do you want to wait?
Go ahead.
Let's keep going. Okay. All right. Mortgage applications are up 2% the week that ended May 6th. That's our second consecutive increase. Now that's despite borrowing cost and the rates going up. It's actually increasing, small amount, but still it's going up, and that's what's important. You know, we're spring buying season now, so this is the busy time going into that in the summer. So to see that trend already tells me that there's still some confidence out there that buyers and sellers have that it is a good time to still buy and sell real estate. Oh. There you go. This one. Okay. All right. Can everybody hear me okay?
Yes.
Right there? Okay. All right. So whatever I really want to talk about, the average interest rate, like what is it right now? You probably already have an idea, but the average on a 30-year fixed right now is hitting just at a little over 5.5%. Now that's for conforming high balance and government loans. That's not jumbo. I know a lot of us here do predominantly jumbo because that's where we are in the Bay Area and it's mostly jumbo loans. Jumbo is still around 4.375 to 4.5. Okay, so I've had people, even jumbo clients calling saying, I'm not buying at 5.5. And well, that's not really where it is. But most of the market, you know, most of the nation is in the conforming area anyway. So keep that in the back of your mind when you hear that. You can say, well, actually, it's a point lower. So now they think rates will come down. Anyway, so about 4.3, 4.5 on jumbo. That's with no points. Okay, you can still buy the rate down. If someone says, you know, I want 4.25, we can get them there. We can get them under 4. It's going to be a little bit pricey probably, but if that's something they want to do, it's definitely possible. Joel Kahn is an MBA economist, Mortgage Banker Association economist, and I really liked what he had to say. He said, despite a slow start this year, spring home buying season, prospective buyers are showing resiliency to higher rates. Purchase activity has now increased for 2 straight weeks. More borrowers are continuing to utilize adjustable rate mortgages to combat higher rates. I'm seeing a lot of people go into 10-1 ARMs. 10-1 ARMs are about 4% right now in jumbo, 3.875, maybe 3.75 depending on your credit score. But we're doing, I would say right now, my business is 80% 10-1 ARMs. It's a long time. It gives people, you know, it helps them not have such a payment shock going from where we used to be, you know, 3.25, 3.5 to this. So it's become a lot more popular. The margin we underwrite on that is not very high, so people still tend to qualify for the ARM. I've got one right now at 4%. We're underwriting at 4.875%, just to give you an idea. Let's see. Yep, share of ARMs increased 11% overall to 19% in the first here part of the spring buying season.
So when you said jumbo, what's the threshold for jumbo again?
So it depends on the county,
All right.
but Santa Clara area, you know, Alameda, Santa Clara County, I've got a chart that I'll show you in a little bit that'll give you all the information, is a loan amount of $970,800 or below. So you can have somebody buy a $1.2 million house, but if they put down money to get underneath the jumbo category and their loan amount's $970,000, they're going to have 5.5% interest rate. So we don't want that. We want them to stay in the jumbo category because then we're at 4.5%. So you're saying, hey, buy more house. You're going to pay the same. The payments maybe not to the dollar the same, but I'd rather you buy more house than pay more in interest. The caveat to that is jumbo requires 12 months of reserves. Now, that's still pretty good considering a lot of lenders out there are 15, 18. I know some that are 24 months reserves, but we can use retirement funds for that. So it tends not to be a huge deal. Yes.
Do you use full timer account?
70%. 70% because market volatility, that's pretty standard. Unless they've liquidated, then we can use 100% of that, but that's not really something we want them to do if we're using it for reserves, unless they have to. Yes.
Can you explain one more time
why the jumbo loan is cheaper? Jumbo loan is cheaper.
Sure, yeah. Well, it's cheaper because jumbo is not backed by Fannie and Freddie. Fannie and Freddie are the ones who basically say to lenders, originate these loans and this is what we'll pay you for it. Okay, well, I believe April 1st, Fannie and Freddie passed on big increases in the cost that we had to pass, well, not just Golden One, of course, but everybody in the country, all lenders have to pass on to the borrower. Basically, they're trying to build up their own reserves, okay, because they see market volatility and it stinks because in a time where we already are experiencing housing crisis and lack of affordable housing, the loans that are for affordable housing, they've increased pricing on. So that does stink, but it's kind of where we are. And there's really not much any of us can do about that other than if we can get our borrower into the jumbo category, even if it's only by $1, then let's do it. Otherwise, we can look at, buying the rate down a little bit, maybe putting on an arm. Conforming still has arms. But jumbo loans are typically portfolio loans. So there's still a guidance of where pricing should be, but we're able to control that a lot more than your government-backed
So
loans.
for like ARM 10-1, 10 year, you mentioned 3.75 to 4% for jumbo. What is it for conforming?
Conforming is absolutely terrible for ARMs right now.
Oh, really?
It probably will get better, I would imagine, at some point later on this year. But right now, conforming and conforming high balance, we're not doing ARMs because it's pretty bad. But jumbo is still, the ARMs are still a lot better. I think you had a question.
Yeah, so you mentioned about that we can get the interest jumbo from 4.25 to below 4.2%. How do we do that?
By buying the rate down.
So by points, right?
Mhm,
So
yeah.
when the client says that, okay, then we use money to buy points, where did the money go? How do you compare that with, they probably will calculate the extra interest
Right.
payment that they're gonna, have to
Yeah.
do it.
That's a good question. I'm glad you brought that up. If any of you guys have been in this before, when the market tanked back in 2008, 9, 10, and all of that, when Dodd-Frank came in and the CFPB was created and the lenders are more regulated, loan officers used to make money by charging points. Now, I started originating by myself in 2008, so I never did any of that, but I know when I bought my first place, they charged me a point on the front, a point on the back, but my rate was high. I didn't know what was really going on at that point, but basically that was just to line the pockets of the mortgage companies, and it stinks, and it was a terrible practice, and I'm glad they can't do that anymore. So, but what it means now is when you're looking at pricing, let's just say 4% is costing 1%, and it's $1 million loan amount. That's $10,000. That's considered upfront interest, and it's tax deductible. I still have to say by law, I have to consult a CPA because I'm not one, but it is tax deductible. So they're paying more interest upfront to have a lower payment through the life of the loan. Sometimes that makes sense. If I've got someone who can benefit, they pay $10,000 at closing, and it's going to save them $250 a month, and they're going to recover that in 4 or 5 years, and they say, this is my forever home, I'm retiring here, then it makes sense to do that. I know people still think that it just kind of goes off into oblivion, but it doesn't. It just buys the rate down, basically, with upfront interest. Is how I explain it to people. Now, the flip side of that is if someone's short cash to close and their ratios can still handle us bumping the rate up a little bit higher to give them a lender credit, then we can do that. And I've had that happen before where someone might be $10,000 short. So what we do is go to a higher interest rate. They're going to pay it. It's not, you're not really going to find lenders out there that are really giving away free money. Okay, the borrower is going to pay it somehow, some way, and in that way they're paying a higher interest rate over the life of the loan to have some upfront cash as a lender credit. It's called premium pricing. Way back in the day when loan officers would premium price, they were making all of that money. It was, you'd have a loan officer closing a $500,000 loan making $30,000 at the expense of the consumer. And it's still terrible. It still irritates me to this day, and it's been a long time. But now everything's regulated, and it's the way it's supposed to be. It protects the consumer, and there are options out there with pricing where we can help people either by lender crediting or by, having them pay a little bit more to get a lower rate. People are not really wanting to do that right now because we're just coming off of jumbo loans at 2.75 with no points. So no, they wouldn't have to pay up for an interest, but now that those days are gone. I'll talk a little bit more about why we're not in that area anymore.
Yeah, speaking of those days are gone, 30 years fixed, people are so like, they gotta have that. Since we don't have that anymore. In brief, what sort of dialogue you have with the buyers, inching closer, perhaps considering a 5-1, 7-1, a 10-1?
Actually, I've got some scripting and I'm gonna, a
Yes.
few more slides. We'll go over that. And then if you want to maybe talk about what you think, or if you've got some more, ideas or something, that'd be great. Because, I want us to all have a conversation. It's not just up to me up here just throwing stuff at you. Okay, so let's continue. Mike, I'm hitting the button. It's not moving. So.
Technology fun today.
Just do this.
Did it work? Okay. I don't know why it's bouncing around. How about
Here
that?
we go. There. Okay.
Why did rates go up?
Yeah. Okay. Why did rates go up? Now, I could sit here and read all this to you, but I'm just going to kind of hit the high level here because you don't want to memorize all this stuff. And we're not going to deep dive into this. Okay. So you can ask questions, but I'm not an economist. So I'm going to give you my best, analyzation of this information, and then we can go from there. All right. So mortgage rates they're basically determined by a complex interaction, microeconomics and industry factors, the level and direction of the bond market, including the 10-year treasury yield. That's the thing I look at every day to determine, do I think we're going to have a rate increase at 11:30 or not? Should we lock or should we float? So I watch that mostly. The Fed, their monetary policy is a huge driver of what happens to interest rates. And that right now is really the reason why we have gone up so much, is because the Fed has stopped, they've tapered buying mortgage-backed bonds. They're going to let their balance sheet run off, meaning they're not going to reinvest that money back into mortgage bonds. They're going to just kind of let it run off. So basically, they're charging more money so that they can make a profit, and that in turn has increased interest rates. Another reason they did that is, or that the Fed increased rates here recently, is because they're trying to fight inflation. I know everybody knows that inflation's up, and it's up, and we're all kind of freaking out because gas prices are higher on average. The same groceries that you were buying this time last year are probably costing you $300 or $400 more a month now. So the Fed is hiking rates to combat that. In a couple more slides, I'm going to go through kind of some historical information about what has happened basically since the 70s with recession and interest rates, and then what we might be looking at going forward. March 16th, the Fed announced that they're going to reduce the balance sheet, just like I said. They're going to do that and reduce new bond purchases. They're still buying right now. I want to say it's around 70 billion. I think every month is what I read. It sounds like a lot, but that's going to stop here pretty soon. They started that in November. I think that's when we all started talking about interest rates going up in my presentations. I know I brought it up to you guys there. Okay, so this is one thing I want you to keep in mind when you're talking to your clients about interest rates are so high, I'm not doing anything right now. Let's look at historical and current rates. So if we look at this chart, back in April of 2001, April 2nd of 2001, we were about 7%, right? You can see that right there. I don't have a red light to show you, but as you can see in 2001, it's just gone down, gone down, gone down. But what that means is since 2001, we haven't been over 7%, and it's just been going down, and we're now 20 years later, and we're still under 7%. So 5.5 is actually still pretty good. You'll probably still see commercials online and on TV that says rates are still low, refinance. I don't think they're low enough to do that, but we're still in a low interest rate market. One thing to think about is the 10-year ARM, right? When rates do go back down, people can refinance. That's always an option. There's no prepayment penalties on any first mortgages anywhere in the entire country by any lender. Believe it or not, people still ask me that. I would say 8 out of 10 people ask me when we're locking their loan, what's the prepayment penalty? And thankfully, they've been outlawed for over 10 years now. So you can rest assured when you're talking to your client and talking about refinancing, you can say that to them and it'll make them feel probably a lot better. Current as of the 12th, Fannie Mae, Freddie Mac loans conforming 5.3 today, about 5.5. 15-year, 4.5. Our 5-year ARM, this is showing up just under 4. It's a little less than that right now because the 10-year ARM is at 4. So the 5-year ARM is a little bit less. Okay, so will rates go down? That's a question I get asked all the time, and I'm sure you do too. So let's talk about what that means and how it could happen. As we talked about a minute ago, the Fed plays a major role in interest rates, mortgage interest rates. Tapering, rate hikes, balance sheet runoff, that's what's caused rates to go up. That is, I just already said, fighting inflation. That's the main focus of the Fed right now, so that's what they're doing. But history can help us kind of see what the trend is, and do we think rates are going to go down, or are we going to look back and it's 7% this time next year? I don't think so, but let's just look at the facts here. So 2021, inflation increased 1.75% to 7. Higher inflation caused mortgage rates to go from 2.5 to 5.5. The Fed is currently tapering mortgage-backed bonds and treasuries. They don't hike and reduce at the same time. So they hiked in May, but they started tapering earlier this year. It's been the most aggressive move since 2000, with the Fed increasing rates, attempting to curb inflation. And they are probably going to do it a few more times this year, and then on into 2023, at least twice, I would imagine. But if they can tame inflation and we get it back to where, acceptable levels, then typically interest rates for mortgages will go back down. Now, they're going to go back down from a higher level, so I don't think we're going to see 2.875 or 3% jumbo 30-year fix, or even definitely not conforming, but we might be in the 4s, going to go up a little bit more. We're at 5.5 now. Hopefully by the end of this year, fingers crossed, that the Fed can get inflation under control, we might be back down into the 4s for these conforming products, okay? Which means jumbo might go down into the maybe high 3s, which is a really great place to be. So you guys pray for that if you are a praying person. Here's the pattern. This is the history of where mortgage rates, how they respond to inflation since the 70s. Now I've got listed here who was the Fed chair, just in case it rings a bell to you guys. I don't have Bernanke on here, but because that part wasn't really didn't apply much to what I'm doing today. But back in the 70s and 80s, inflation was 7 to 14%, mortgage rates 12 to 18%. The Fed fund rate 11 to 20. The inflation response took it from 14 down to 5%, and mortgage rates went from 18 to 12. And then we had a recession. The 90s and the 2000s, inflation 1.75 to 3.5. That sounds pretty familiar, right? We were at 1.75, now we're at 7. So we're kind of doing worse with inflation than we were back then. Mortgage rates, though, were 7 to 8.5%. The Fed fund rate was 4.75 to 6.5. It has been 0 here lately, or in the past, the recent past. Inflation response, then we went from 3.5 down to 1%. Mortgage rates went from 8.5 to 5.5, and then a recession. So another thing to think about in the back of your mind is we probably will be going into a recession towards the end of this year, I would imagine, based on the past 40, 50 years. What's happening right now with Jerome Powell? Inflation went from 1.75 to 7. Mortgage rates 2.5. I'm sorry, this is 3.375. That should be 5.5. Fed fund rate went from 0 to 1%. What's the inflation response? It should drop. So inflation should come back down, and then interest rates should come back down if it follows the same pattern that it has for decades. But then what's going to happen? A recession, okay? So that's really not a super big surprise there, because we can see it in the history. Talking points. Okay, so this is where I want you guys to kind of focus if you can, because this is what we want to talk, the things we want to talk about to our clients to get them more motivated to buy or sell and not panic so much about where interest rates are right now. Like we talked about, utilizing the 10-1 arm, about 0.5% less or so than the 30-year fixed. When you're talking about $1 million loan, $2 million loan, that's a huge difference in payment. And so far, I have no objections to anyone going on an ARM. They're protected. There's rate caps. It can never go 5% over the note rate. These are not these crazy ARMs that were way back in the day where there was no cap or the cap was 15%. So it's not like that. Always refinance whenever when the market drops. So no prepayment penalties on mortgages. Rates are still lower than they were since in 2001. 2020 and 2021 pricing, that was mostly due to COVID, supply chain shortage as well, but mostly due to COVID. Now that's not something that we normally see, right? Hopefully there's no other pandemic that's going to hit us. I would not want a pandemic to have lower mortgage rates. I'd rather us just all be healthy and happy. So when you're talking to your clients, you can say, well, that was great when it was happening, but it was because of COVID, and now we got to get back to normal levels so the economy can recover and we can all balance out. Redfin reported the first time in 6 months that home competition dropped from 67 to 65. Only 2%. That's not a huge number, but it does at least tell us something's changing in the market. Are you guys seeing any of that with your listings, or when you're trying to make an offer or anything like that? You're not seeing that yet here. These are national averages, so it's not going to be specific Bay Area, but you might see it here coming soon. Rates are probably going to go up a little bit more, slower pace. They kind of rocket shipped us up to 5.5 so far, and I don't think they're going to go quite much further high than that, or definitely not as quick. Inventory shortages, still definitely have a shortage of inventory. That means home prices are going to keep rising. So when your clients say, well, I'm going to wait for home prices to go down, not going to really happen here. Okay, I've got some talking points on that, or some scripting on that here in a minute. Now this doesn't have anything to do with me, but you guys, if you have cash buyers, they're still playing a big role in the housing market. Interest rate doesn't matter to them. 30% of transactions on the national average were cash. So if you've got cash buyers, then get out there and try to get them in, because the interest rate doesn't affect them at all. Now this is something I typed in here because I come from Georgia. I don't know if you can hear it in my voice, but in Georgia, the seller always pays the closing costs. So when I moved to California and I'm seeing all these contracts, I'm like, where's the seller contribution? There is hardly any. It's like maybe the transfer tax or home warranty or something like that. But in Georgia, it used to be a thing all the time. So now I don't know that you need to do this right now if you're more of a listing agent, but it is something to keep in the back of your mind if you get into the time of the listing where maybe you're not getting the offers you want. Maybe it's anomaly and you think you're going to get 20 offers and you've got 2. Maybe the seller can pay towards maybe the rate buy down, if that might help, your guys get the house sold. A rate buy down can be, 1%, 0.5%, it can be 1/4. Sellers can typically contribute up to 6% of the loan amount as closing cost credit. So if you want to utilize that, it's there. I'm just letting you know that lenders are fine with it. It doesn't matter if it's jumbo or conforming or government or anything like that. It's an option. So if you've got someone who's rented for forever, then let's talk to them about the tax advantage of paying interest versus rent to help them build wealth, right? Because even though you're paying interest, you're still paying principal, so you're getting that back, and then appreciation. About 8% or so on a conservative level is what they're projecting this year. So still a lot better than paying rent. Okay, here's some scripts. So I'll just read these, and if you guys want to chime in, or maybe you've got an idea of how you would respond, let me know. Or maybe I'll put somebody on the spot. Can get ready. Okay, so you're with a client. I've got this printed for you in your packet, so you can still take a picture, but it's there for you. I can't afford to buy now. Rates have gone up. Okay, well, rates are still lower than they were since 2001. and you can refi when rates go down. Rent's projected to go up another 5% year over year. Better off paying yourself the increase in interest rate than, you're better off paying yourself than, what does that say? You're better off paying yourself that increase in home appreciation. Sorry, that was 2 a.m. when I typed that, sorry. You're better off paying yourself the increase in interest rate and then realizing home appreciation. Maybe I should have some more. Okay. Anybody have a, if you didn't get one, I've got several more folders. I may have missed that one. I apologize. I've got more folders that's in there.
Could you say for the people that are online how they can get a copy?
Yes, if you want a copy of the presentation, just email me and I'll send it to you.
And is your email in the chat box?
It is, and it's also on the front page. Well, you don't have the presentation, but yes, it's in the chat box. Thank you. Anybody want to have anything that they would say to someone that says that? Interest rates have gone up, I can't afford to buy? No? Okay. How about I'll wait for home prices to go down? I'm sure you hear that a lot. I still hear that.
What if they're changing?
What do
What
you
if
mean?
they're, want to go to better house?
Yeah, do it. I'm not sure.
No, I mean, you're talking about rent, but if they're not renting.
Right, and if they just want to move up or something, yeah, I mean, it's a great time to do that. If they're selling, then they're going to get, higher price when they sell and, yeah.
So, when is it a good time to move from one house to a bigger house? Is it when prices are high or when prices?
Anytime.
Anytime. The salesperson in the ground. So if we wait for the other one to go down, then we're gonna get left, right? I mean,
To get
you ought to sell at the top, not at the bottom. This is my theory. That's all.
Sell high, buy high. Hey, that's a good concept. Okay, so basically Bay Area is not likely to cool down. Even with more inventory hitting the market, there's still a shortage of properties. Even this spring, they're projecting, several thousand more homes hitting the market, but there's lots more buyers than there are going to be homes. So there's still going to be competition from buyers. So not a good idea to wait. How about this one? The bubble's going to burst. I'll wait till that happens and rates go back down to where they were last year. Have you guys heard that yet? I hear that. I hear people talking about the bubble bursting. Well, there's not going to be a bubble burst because what happened that created the bubble burst a long time ago, the mortgage meltdown, that's not the reason rates dropped here in the last couple of years. It wasn't because of irresponsible lending. It was because of COVID. So that's not likely to come back, hopefully. So it's not likely the housing market's going to crash. I believe if it felt like that was going to happen, the Fed would step in, but it would really take something catastrophic, maybe another, major pandemic. But that's hopefully not likely. Yes, ma'am.
So I keep receiving emails in the foreclosure because of COVID that some landlord cannot put in their mortgage payment, and the government is like holding on to eviction, and then holding on foreclosure. So will this be open up for some foreclosure?
Oh, I see what you're saying. There could be some foreclosures. I think the last I read, there was, I think about 300,000 people came out of forbearance with their mortgage, but they're still delinquent. And they may not be able to catch up. But what lenders are allowing is for them to put a balloon note on the back of their mortgage. It's not technically a balloon, but they're saying, okay, you're behind $100,000. You don't have $100,000 to put in. Otherwise, you probably wouldn't be behind in the first place. So we're going to take this $100,000 and tack it on to the very end of your mortgage. They're not going to pay additional interest on that. Okay. But when they sell or refi, then that will have to be paid. So that's going to help a lot of people be able to maintain, their housing and not be evicted. So I still don't think it's going to result in tons and tons of foreclosures. A few, but I don't think it's going to be anything like what we've seen in the past. Yeah. How about, I keep getting outbid. It's so disappointing. You guys getting a lot of people discouraged. I know I've got people I've been pre-approved since last year in May, and they're still not able to find a home. So, okay, of course, I'm gonna say, let's make sure your offer is competitive. You know, I've got this one person who keeps making offers every week under list price. He loses every one of them and he gets all irritated. And I'm like, well, you're just not doing it right. Like you're not gonna pay under list price. This is not a bargain market for buyers, right? You're gonna have to be competitive. Single family homes are going for what, 15, 20% over list price about, right? So if it's listed for 900, you better offer 1,050,000 or something like that, or 1,500,000, well, not 1,500,000, but 1,050,000. You know, let's be competitive. And the property will probably appraise. Okay, we all know that listings are priced under, right? Y'all do that to generate some buzz and get people interested. But if you know what you're doing and your client understands it, then list price is a suggestion. It's basically, hey, I'm for sale. But you know, let's help them be a little bit more competitive and understanding of what it really is like out there. Fully underwritten loans, we can fully underwrite the loan, so there's no no finance contingency. I know you guys probably don't put finance contingencies in there anyway. For the lender, for me personally, it can be risky because the only thing I can attest to is credit, income, and assets. I don't have anything to do with the property or even know anything about the property, if it's gonna appraise or anything like that. So the appraisal contingency, yeah, you pretty much can't have one, but just know that you've got to do, you know, the best job you can at when you're pricing that offer. If it gets accepted, that it's going to appraise, or we can have a conversation with your client about, well, you don't have to put 20% down. Maybe you put 5% down if it's conforming, or just 10% down if it's jumbo. So we can kind of help out with that a little bit. Yes, sir.
Yeah, how long does that fully underwritten process take place?
So for what we call TBDs, to be determined, so they don't have an active contract and no property address, about 3 to 4 days. It just depends on how many go in the same time. You know, if I've got 10 that go in one morning, then it's gonna be a lot faster, but if we've got 25 that go in, it'll be a little bit longer. But it's pretty quick considering, you know, it's not a live deal, but we still underwrite them fully, like a letter from the underwriter.
A commitment letter or something that would attest to fully underwritten.
It comes with a conditional approval letter from underwriting. So you'll have my approval letter, but then you'll have an additional one that shows you've been fully underwritten. Yes, Lynn?
How long is the approval last?
120 days.
120 days.
Mhm. Now, at that point, we would just have to repull credit because credit will expire. We want to make sure, of course, that your client doesn't quit their job, get fired, or take a pay cut or something like that. But, you know, you guys, that's pretty basic knowledge. Yeah, for 4 months, a lot of time. Anybody else have a question? Okay. My finances have taken a hit from the stock market going down. I don't have enough money. Okay, well, you might need less than you think. I still get calls where people think they have to have 20% down. Even if it's a $700,000 house, have to have 20% down. No, you don't. You actually, 5% down will do it on that, depending on the county. So let's talk about it. Instead of people assuming or thinking that they know, because most people, it's crazy, they don't understand their whole financial picture. You know, I see it a lot every day. I'll have conversations with people. I'm like, well, you have more money than you think, or your credit's better than you think, or you make more than you think. Can also go the other way. So it's really good to put your client in front of a lender, preferably me, of course, I would love it, but put them in front of somebody to have their full financial picture analyzed so that they know exactly where they stand. They know exactly what's the maximum purchase price that they can buy, so they're not out there guessing or assuming. Lynn, did you? Oh, you did, okay.
Like you just talked about 5% and 10%. So sometimes people want to have a certain amount of monthly payment.
Mm-hmm.
So when we do 5% or 10%, the payment becomes bigger. So what do we suggest our client about?
Well, if they're on let's say okay, I don't want to pay more than $6,000 a month for everything, taxes, insurance. If they put 20% or less than 20% down, mortgage insurance, of course, then what I do is I structure the loan so that that payment is at $6,000, and then we tell them, this is your purchase price, this is your down payment. Is that where you can be?
They have to pay PMI on it too?
Yes, yes, but PMI is cancelable. So I know a lot of people are like, yeah, mortgage insurance, but mortgage insurance is super cheap. I've got $1.3 million loan amount, 1.5 or 1.6 purchase price. The mortgage insurance is $150 a month.
Really?
It's super cheap, yes. So,
People tell us it's gonna be 300 or more than.
right, because they're doing these calculators online that are just guessing at what the person's situation is. A lot of times they're looking at an FHA calculator because they think that's what they're gonna have that mortgage insurance, and it's not ever close. You know, I get it every time I have to put MI on a conventional loan. They're shocked at how cheap it is. And if I say, all right, well, you can put another 150,000 down to avoid this, or you can make that 150,000 work a different way for you than getting, you know, $150 a month. That's, I mean, in the grand scheme of it all, that's kind of pocket change. When you can let the market over year give you that appreciation, as soon as your buyer or your client thinks that they've got equity, then we just do another appraisal. They have to pay for it, but we do another appraisal. And then as long as the equity is there, the mortgage insurance is dropped automatically. So it's not something they have to pay forever. We don't require it to be paid any minimum amount of time. It could literally be dropped the next month.
Do you see appraisals for refinances work exactly the same as appraisals for purchases, or there are any differences?
Well, the thing about the purchase appraisals is the first indication of value is what a buyer and seller agree. So you've got that going for you for a purchase. So typically purchases, I'm seeing them come in at about contract price. I should knock on wood. Refinance appraisals, when we send those in, the orders in, they still know what the value is or what we think the value is. So they've got some guidance, but I would say that you have a better shot of getting what you want on a purchase than a refi, but refis are going to be a little bit more conservative anyway. But if you're in that situation where you have an appraisal that comes in lower than you think it should be, we can rebut that.
So you're saying there was no conservative asking, we feel like they have different appraisal standards for refi?
The standards are the same. The appraisers should be appraising the exact same way. It's just that purchase agreements, you know, definitely helps give the first indication of value. But you'll see, I mean, appraisers, it's all, you know, their opinion. You know, you might have two appraisers go the same day, same property, do the report, and you've got two different values, $50,000 difference.
And see any possibilities for appraisal shopping for refi?
What do you mean?
Did one appraisal, we don't like it.
Oh, no, so you can't really, lenders can't accept a borrower ordered appraisal.
I understand, but if you wanna get a second opinion, can you do that?
If the only way we would order a second appraisal is if the underwriting team thinks that this appraisal that we have in is not a good appraisal and we rebut it and the appraiser comes back and doesn't make any changes. You know, so let's say that you've got a purchase contract and you know that this house over here is going to close in 2 weeks, but we're doing our appraisal this week, but you need that comp. Well, let's wait. Okay, it might give us a little bit of a delay in closing, but if we need that comp to make it work, then let's just have the listing agent make the appointment after that home is recorded. And then the appraiser can use it, but not pending, only recorded.
But you don't have to refi or anything, it's just a pray to lower down the.
You don't have to refinance to do that. Just get an appraisal. You'll pay for it. We'll order it, but you'll pay for it. Well, the client will pay for it. And as long as the value's there, then we submit that to the MI company and then they cancel the MI.
Rate will change.
No, nothing changes except the MI goes away. Yes, sir.
For refinances, what sources of data do you use for appraisals?
Same, recent comps, even sold, recent solds will indicate what the value is of that property now.
And if there aren't any recent solds within like 3 miles?
Well, the appraiser will have to go out until they find some, but that could be a challenge. You know, I mean, the appraiser really wants to stay within that radius and wants to stay within 90 days, but there are many occasions where you can't find a comp or you've got a really unique property that's hard to appraise. So at that point, we might do 2 appraisals. Anybody else? Okay. All right, let's see. Statistics for Bay Area counties. I'm not going to read every line, but you can see, let's just hit them up. Bay Area up 18%. San Francisco County value up 10, almost 11%. Alameda 22%. Contra Costa 22. Marin 15. Napa 12. San Mateo 16. Santa Clara 18. Solano County 12. Sonoma County 10. I mean, that's a lot more than 8% appreciation from what they're projecting. So
This is just for single families or?
this is pretty, yeah, for single families. So, but this is a tool I would use when I'm talking with people about MI and keeping more money in your pocket. Don't cash out your 401k. You know, 401ks have taken a bit of a hit. Don't cash out your 401k, right? But just put your 10% down if it's jumbo and let the market give you that appreciation. All right, so we've talked about that. I'll pause for a minute so we can do any Q&A on what I've just covered, and then we'll talk about the condo changes. Yes, sir.
So how would you set expectations about what appreciation they can expect?
Well, you know that we'll never say your home will appreciate, but the trend, I would just reference what the market trends are, what they've done in the past quarter, and what we're projecting. I mean, we just looked at, you know, what happened with prime and recession, all that for the past 40, 50 years. We can do that with real estate as well. And we all know the Bay Area is its own kind of ecosystem where properties still tend to go up no matter what's happening with the rest of the country. Yes, Lynn?
I just want to piggyback to what you said, you know, when you answered the question. I think for sure that none of us have a crystal ball. Nobody knows what the market is going. People pretend that they do, but nobody really knows. So I would say, first of all, you don't buy a house and sell tomorrow, right? The average stay years, because I do farms for a lot of realtors, the average stay years in most markets used to be 7 or 8. Well, guess what? It's 15, 16, 15 years. So if most people purchase a home and stay in a home for that long, you don't really care, right? There's appreciation. Most of us build wealth on real estate. So if you own it for a long term, it will pay for itself.
Right.
So maybe that's something that you can ask your client is, what is your plan? How long do you think you're gonna stay in this home? And then you can have that conversation.
Mm-hmm. And I always suggest too, you know, you're buying owner occupied, let's say it's, you know, 4% interest rate. You think, okay, well, this is my starter home, probably gonna grow out of it, have a few kids, and I'm gonna need something else. So my suggestion is, well, then let's start building a real estate portfolio for you. You don't have to sell it, you know, unless you need the equity to be able to buy something else, but then we have ways around that. You know, let's build your real estate portfolio. You've got 4% now on investment property. You know, let somebody else pay that principal and interest for you. You get the tax deduction. Overall, it's a great thing to do financially. I don't have a home insurance agent here, but you can get rent loss insurance coverage, you know, so if you did have, you know, something happen, the home insurance can come in and help with the rent. Yes.
Yeah, so 2 days ago when I was prospecting in front of a couple of venture capitalists, so they asked me a question I couldn't answer. So they said that right now the California population is decreased over like first time in over something years of that, and then the interest rates going up, and they don't think that the price of the real estate will sustain as strong as before, and a lot of people moving out of California, moved to Austin, and how do you suggest to address that?
Yeah, I started hearing that as soon as Tesla announced they were moving to Texas. And then everyone was like, Apple's gonna close, Google's gonna close, everything's, you know, I don't see that happening at all. There's still a lot of people that move into the Bay Areas. And I know there's a mass exodus of people moving out, mostly driven by COVID and not being able to sustain their employment and housing. So they're moving to, you know, smaller areas that are a little bit more affordable. But there's still a lot of people trying to move in. So I don't see that that's happening. But, you know, that's, I think, more of a temporary issue than anything. I don't think that's a long-term thing that we're going to see happen just slowly. Then all of a sudden we'd look around, we're in farm country here. I don't think that's going to happen.
No. Also, some of the companies that announced, like Oracle announced they were moving to Texas. This is just for new staff. The people that are there working, they all said, we're not going anywhere.
Right, definitely. Okay, so is everyone good? We're ready to move on to quick little condo changes here. Okay, how many of you guys sell condos, list condos? Is it a big part of your business? Yeah, okay. So there's some condo changes that came about this year, and I'm going to just kind of briefly talk about it. I have in your packet the Fannie Mae Linder letter. I know it's not something you probably are going to enjoy reading, but grab a glass of wine or a cup of coffee and just read through it, just some high points of what happened, why the changes have come about. You'll read that it's temporary, but just expect it to become permanent. This is not something that's going to go away. So this is all in wake of the tragic Champlain Towers that collapsed in Florida last year, and so many people died. It was horrific. But there was a lot of lax. There's a lot of HOAs out there that have a lot of, I guess, they're super relaxed in the repairs that need to be done. They've got a lot of deferred maintenance out there. These condos are starting to be 20, 30 years old that went up, a couple decades ago, and there's a lot of repairs that need to be done. People are getting special assessments, racking up the money in the reserves, but then the condo association is not doing the repairs. Well, you've got people running a board of condo association that aren't construction, they don't have construction background, they're not building engineers, they're not accountants, they're not anything, they're just homeowners trying to do their best. But it's something that we'll have to address because it's the new change and it's going to be around for the very foreseeable future, if not forever. And when you look at the details on why, it makes sense why Fannie Mae and Freddie Mac have come in with these changes. Let's see. So basically, when you do a condo, as the lender, first of all, before you write a contract and really before you even take your client to a condo to show them, please call me, text me the condo association name, and let me look at the condo to see if it's even eligible for financing. Because there are some that are not. It doesn't matter how much they want to buy, or unless they've got cash, it's not going to pass, not with just me, but any lender. Every lender looks at Fannie Mae's condo approval list to find out if it's something that they can do. I'll talk about that in a second. Okay. So basically the new questionnaire that goes out that the condos has to fill out unless it's already Fannie Mae approved. I have one that's Fannie Mae approved. It's the first one I've had, condo that I've had Fannie Mae approved in probably 3 years. Okay, so it's not super common to have it approved, but there's ways around it if it's not. But if it's already Fannie Mae approved, then you don't really need to worry about this part. But if it is not Fannie Mae approved, and we have to do what's called a limited review, meaning we get the HOA questionnaire and then we analyze that to see, are we comfortable lending in this? Is Fannie Mae going to buy it, or does it still meet their guidelines? We're going to look for deficiencies, damage that would impact health and safety, deferred maintenance. That's the big one. So keep that in your head. Deferred maintenance and special assessments. So deferred maintenance, basically what I said, they're collecting money because maybe the garage has a big crack in it and it's needs $500,000 worth of repairs. Well, the homeowners have to pay for that. So they're going to special assess, put that money aside, and then what? It could be years before they do anything. You're kind of chuckling. You might have some experience with this already, right? Yeah, okay. So basically that questionnaire, if the association does not want to answer this part of the questionnaire that's new, and they don't want to, okay, the response I get is, we've been advised by counsel not to answer this question because of the legal liability if we do. Because if they say there's no deferred maintenance and no problems, we close and then there is, then you know what happens to the HOA, right? They get sued. So they don't want to answer that question. So then you're like, well, what do we do? Because we have to have the information. We have to know what's going on with this particular complex right now. So there are ways around it. Let's see. Well, I've already talked about this. One thing that Fannie Mae has added is a 10% reserve requirement for the association. If they don't have that, then we can do a reserve study to find out how much really is needed. Well, not we, but they will. If there's special assessments on the questionnaire, then we need to know what they're for. If it's because they want to replace the garage doors, who cares? We don't care about that. We're really looking for health and safety issues. If there's deferred maintenance, then we need to know what it is, because it could cause a condo not eligible for financing. I just closed one 2 weeks ago that had deferred maintenance, and then everyone was freaking out. But we found out it was from a small fire in the stairwell. I don't know the details of how that happened, but there was deferred maintenance. The condo association insurance, master insurance already fixed it. It was just still left on, in their budget and everything, but it was fine. We closed, no problem. So don't be scared by this, but just let's talk about what it is. And let's be frank here, if you've got a buyer that wants to buy a condo and there's deferred maintenance that could cause a health and safety issue, you don't want them buying that anyway, right? Okay, so like I said, they don't want to take the legal responsibility to answer that question. So what can we review instead? We can review the balance sheets, bank statements, the reserve study, the HOA meeting minutes from the last 6 months, and the annual budget. What that tells us is, in the meeting minutes, did they talk about deferred maintenance? Was something brought up that there's a problem? And if there was, well, let's see the budget. Are they holding out money for deferred maintenance? There's special assessments for deferred maintenance. We look at that, and if there is, then we find out what it's for. And if it's not for anything, like I said, that's health and safety, we can move forward and still close. But it could be a problem, so we don't want to get caught, close to the end of a transaction, and we find out all of this stuff, and then everybody's all in an uproar. So very important to let me know ahead of time where you're going to show your client. It takes me 3 minutes at most to pull up the CRM. It's something that lenders have access to. You guys wouldn't, but I do. And I can pull it up, screenshot you the information, and then tell you if you're good to go or not. Now that, I'm not saying that I know about deferred maintenance, but you're at least, you can show the property, and then we can go from there. Thought I saw somebody.
A question.
Yes.
So that's for the buyer. How about for the seller? If you're a listing agent, how do they know if this condo is?
Well, the homeowner should know. I mean, they should, if they're paying attention to the HOA, the meetings and budget and everything like that, they should know if there's deferred maintenance. So that's a question you can ask them at the listing appointment. Do you know of any deferred maintenance? Has there been any special assessments that you're having to pay for now? And if so, what is it? Why? Call me if you've got a question about it. If they say, well, it's this or that, then just give me a call, and I'm happy to give you what my opinion is on it. Of course,
But
it's not.
homeowner will not know if the condo is under this Fannie Mae approved.
They probably wouldn't know, but you can look this up online. Fannie Mae condo approval list. It's on there. It's public record. My system has a little bit more detailed information, so I can see a little bit more updated stuff and a little bit more detail about the association. But if you're taking a listing in a condo, let's talk about it first before you go through that, and then find out that it's not going to work, or you list it and it's all cash offer.
I remember when we had coffee, you mentioned, but maybe you can repeat, what kind of condos does this affect?
This affects, okay, yes, and I think.
Or maybe you're
Thought
going
I
to get
had
to
this.
that
Oh,
point.
no, it's right here. Okay. This affects units and projects with 5 or more attached units. So if it's a condo, looks like a townhouse, but if it's a condo, there's 3 side by side, doesn't matter.
Okay.
Right? If
5
it's
or more.
5 or more, and that's when we have to start looking at it. Yeah. Okay.
Question real quick, please. What about homeowner to rental ratio? Is that included?
Golden One doesn't care about that.
Okay.
A lot of lenders do. They don't want it to be more than 25% investment property, basically, but it's not really a big concern for us.
Okay.
The 10% reserve requirement, 10% of what?
The annual budget.
Oh.
Anybody else? Okay, I've actually already talked about this stuff here. If you guys want a copy of this presentation, like I said, email me and I'll send it over to you. This is a lot of good stuff. You're really going to set yourself apart from other agents. Let's say you've got a seller and it's a condo and you go to a listing appointment, they've got 5 other listing agents they're meeting with, but you talk about this, maybe the other agents don't, then you're already the expert. They're already going to have more faith in you, that you know what's going on in the market, you're up to date on new guidelines, and you're going to help them, make the right decision. The rest of this stuff here, I've gone over this before in all of my calls. These are just some of my basic slides about our down payment requirements and things like that. One thing I want to mention, and I mentioned this the last time I had a call, is multifamily homes. If you guys don't really get into those, you might want to. They're up 30% here, 30% higher sales of multifamily and commercial, but multifamily homes. If you own or occupy a duplex, tri, or quad, and it's a certain, we can keep it in a certain loan amount, then it can only, if you go FHA, if the property is good with FHA, you can only have to put 3.5% down. So you're talking about, you know, a duplex, you can go up to 1.2 million on the loan amount and still with only 3.5% down. Quad, up to 1.8 and some change on the loan amount with 3.5% down. So that's a great way to have your clients invest, right? Owner occupied, you only have to owner occupy it 12 months. Then you go buy another one.
So to confirm that the FHA, you can have just 3.5% down on more than one unit, because other lenders have been telling me that there is a high down payment required.
For conforming, it's 15% down. Yeah.
So that's for duplex?
For duplex, 2 to 4 unit is 15% down for conforming. FHA is 3.5. If you owner occupy,
Oh, right, and that was my question. So FHA owner occupied is
3.5.
Still 3.5%.
Yes.
down.
And I know people are like, oh, FHA, but it can be a really good tool to,
So are you actually seeing a lot of reviews being done, or just one of those things that people talk about, but doesn't happen?
yeah. I mean, I'm actually, honestly, Mike's helping me right now look for one. So, I mean, I'm kind of excited because my plan is 12 months and I want to buy another one, not with FHA because you can only have one FHA at a time, but then you just, you know, you can refinance it into conventional and then, you know, let the market with the appreciation.
So what's the interest rate on that duplex, for
Um,
example? For the
for-
15% down,
Well, 15% down, well, it's going to depend on the loan amount.
for the jumbo.
For jumbo, duplex, probably, I'd say 4.7, 4.8 maybe.
That's it?
Yeah. The duplex, any kind of multifamily home is going to have a little bit higher of an interest rate, but not by much. Here's the loan limit increases. So if you want to just say, okay, where are we? Santa Clara County. It's kind of small. Let's just look at Alameda because it's the top one and it's the same as Santa Clara. In Alameda, a 1-unit, single-family home, condo, or townhouse, the loan limit from Fannie Mae is $970, $800, and above is jumbo and below is conforming. Duplex, 1.243, triplex, 1.5, quad is 1.867. These are the same loan amounts that FHA has. So a quad, you want to buy one for $2 million, but you know, as long as you put enough money down to keep your loan amount at 1.867275, then it's 3.5% down. So pretty good a tool for investment, I think. Owner occupied one unit though, for sure, 12 months. Okay. Golden one, 12 months reserves. Tax returns typically not required unless it's self-employed or we need rental income to qualify, then we'll get tax returns. A lot of lenders want tax returns on jumbo loans. Doesn't matter if you're just straight up W-2, base employment, nothing else, they still want tax returns, but we don't. We work with RSU, restricted stock units. You know, that's huge in the tech world. We work with those all the time. I think compared to my counterparts at Chase, B of A, and Wells, we're a little bit more lenient on underwriting guidelines on that and tend to give a little more income than the other places. Waiving escrows on jumbo loans or conforming. If you put 10.01, I missed the 0.1, but if your loan to value is 89.99%, then you don't have to set up an escrow account. Typically, you've got to put 20% down not to do that. Well, what I like to utilize with this is have somebody put a few extra $100 down, but you don't have to bring $10,000 to closing to set up an escrow account. So it helps with cash to close. Yes, sir.
There's no MI on that.
Yes, there is. There's all, yeah, we don't have any less than 20% down, no MI. There's going to be MI, but like I said before, it's just super, super cheap right now. 700 minimum FICO on jumbo. We can actually go up to a 50% ratio on jumbo with compensating factors, you know, good credit score. They've got 12 months reserves, but maybe they've got 15 or, 16, 17, 18 months reserves. Then we have a good case for getting up to 50% ratio on jumbo. Asset depletion, we don't do a lot of that, but we can. If you have somebody that maybe doesn't have the income, but they've got a lot of assets, then we can calculate a way to use the assets as income. I'm just hitting some high points up here.
Yeah, do you do layering loans like county grants, DPAs, and that?
No, we don't. But you know, if you guys have heard about the down payment assistance that came out for us around here, I think there's 5 million available for down payment assistance, 10%. The government will help 10% of the purchase price as a forgivable loan. You guys stay in the property 5 years and then they wipe it out. There's 0% interest. We don't do those. But if you're interested in it, you can Google it and there's a preferred lender list on there. We're just not set up to do it. It just came out. We're just not physically set up to do it, or we would. It's only, I think only about $5 million in that purse right now. So I don't think it'll last, you know, super long, but you know, it might be something to look into if you've got somebody short on cash to close. Anybody else have any questions? That's about it. I mean, I've got, you know, what time is it? It's 1:40. You guys have been troopers here. I'll send you guys this presentation. I'm sorry. Oh, thank you. One thing to keep in the back of your head is we do go up to 55% ratio on departing residents. So if you've got a client who they listed their house, they've got a contract, all the contingencies have to be released, or not all, but the finance and appraisal contingencies have to be released, but maybe they're not going to close in time for them to close on their new purchase, and their ratio is a little bit higher because we have to include that payment. We can go up to 55%. Now, what if their sale falls through, right? After closing, well, that is what it is. You know, we're not going to go back and take anything back from them, but we do allow that, which is actually pretty awesome, I think. You had a question? Okay. Well, that's about it. Oh, yes, sir.
Where's most properties being bought all cash from? And as far as the groups and
Where is money coming from?
where's money coming
Overseas, for the most part.
from?
Yeah,
Thank you.
yeah, a lot of that is happening. There's other countries that don't really invest in the stock market like we do. So where they put their money in, you know, American real estate.
By the fund, of course, right?
Well, all cash, I don't ever really get into that, so I don't know. Now, if we're using foreign funds we're doing a loan and we're using foreign funds, then we're fine with that as long as it doesn't come from a sanctioned country. But we use foreign assets all the time, and we don't require bank statements from that country. We don't get them. A lot of lenders want them and they want them translated, but we don't even do any of that. We just need to see the money has hit title. And then if it's gift funds, which usually it is, then we just have a gift letter, and the account number on the gift letter has to match the wire into title, and then we're good to go.
What do you think the percentage is of cash buyers in the area here?
The stat was about 30%. 30% cash
So it's
buyers,
kind
yeah,
of a
for the first
flow
quarter.
economy, right? It's
Mhm.
kind of a.
Yeah, it is.
So it's kind of like keeping it there.
Yeah.
Okay.
Mhm. Yes, ma'am.
Are you funding yourself?
Yes, we fund direct out of our office in Sacramento. We're a direct lender. We're not a broker. We portfolio most of our loans. Of course, we sell to Fannie and Freddie like everybody does, but we keep those loans on our books. We don't sell servicing or anything like that. We always reserve the right to, every lender reserves the right to sell the servicing rights to a loan, but for the most part, we keep them on our books.
So what's the best way to record?
Call, text. Yeah. I really love warm transfers where you've got someone on the phone. Just send me a text and say, hey, can you talk at 2 o'clock? I have someone. Getting them on the phone right away is super important. If I just get a name and number to call, you can bet 50% of the time they're not going to call me back. They just don't. And then I'll call again, and I just don't hear back from them. But if I can get them on the phone and we can have a conversation, there's a little bit more traction for you and for me. But yeah, call, email, text, anytime, weekends. Real estate doesn't stop, okay? So I don't either. I did a loan application 9 p.m. on a New Year's Eve one time. It's $2 million. I was happy to do it. So yeah, I'm always available to you guys if you need anything. You know, I've got 2 offices, one downtown right around here, one in Campbell. Don't see a lot of people coming into the office to meet because of COVID still, but you know, if you want that, I'm happy to do it. So just anytime you need anything, just let me know. Okay. All right. Thank you, guys.
Thank you.
Have a great day. Thank you.
All right,
Everybody online, thank you very much. Sorry we weren't able to get to all your questions, but contact us.